Alright, so today, one of those interesting days. You get a lot of limit order tight trading range trading right in the beginning. And then, you get a breakout that you get a big spike in channel. So for a swing trader, days like today can be great if you can manage to not dig yourself in a hole. You know, very similar to Tuesday. Days like this where, this will kill swing traders. You will, if you're not careful, you will lose, even especially on a day like today, you buy above, you either buy above, get stopped out down here, we did buy, reverse to short, reverse to long, you know, very difficult to do. Very, very difficult to do. And I don't know if you are in the room, but if you heard Al today, he started talking about signal bars on the open where finding the best signal bar of the day, which is something he does every day. And that's one way to help with always in. Always in is important whether, whether or not you're a swing trader because it'll cue you and let you know what the trend most likely will be. If it's, for example, first bar of the day, here, when you see this bar, you could say always in short just because of the close, but it's not a great stop entry. Bar two. Well, right now, if you had to pick a stop entry, it's probably a stop entry above because that is the best signal bar of the day. Well, so far of the day, as in the first three bars. Clearly always in long, but now you get bar four on 850. Well, at 850, if you ask yourself what the best signal bar is, you're going to say it's 850. So if you're long, you need to get out, potentially go short. It's similar to yesterday. 835, probably buyers below, but it's an okay short. However, this bull bar, this stop entry, is better than this short for the simple reason of risk. A stop entry ideally is a swing trade in most cases. Therefore, if you're taking a stop, you need lower risk to compensate for the lower probability. So low risk, high reward, I'm sorry, high risk, low reward, lower risk, lower reward. Think about which one sounds better. It's this one. You know, high risk is good when you have high probability. And what I meant to just say, I meant to say high risk, low probability, lower risk, lower probability. No, higher risk is great when you have higher probability, but not when you have a lot of risk, not when you have low probability. And if you look, so look at 850, this stop entry right here. If you're short, what do you do when you see this? Which stop entry is better? Well, it's still probably 850. I could see getting out above here, but you're going to get chewed up if you buy above, sell below, buy this bar, short this bar, buy this bar, sell this bar. You got to be really good to do that. And if you mess up slightly, you're going to lose a lot. Instead, what I'm offering is to simply you sell 850. Maybe you think, okay, I'll get two legs down, I'll hold above here, but then again, here's three pushes down, triangle. I still think it's always in short because of the signal bar, but I'm going to get out of my long here. Or maybe you say, okay, I'm just going to, I think it's always in short, but I don't like this, this going against me. I'm going to get out above 905, and I'm going to look to take a stop entry short. Well, maybe you say, okay, I'll get short again here, and you sell. Then you see this part and you say, well, maybe it's a triangle. may get one more push up. I'm going to get out above here, but I still think it's always in short because this is the best signal part. Well, you went short here, but you may short here, thinking, okay, well, these bears are still in, still probably always in short. Now we have a second entry short up in this range. I'll short again. Take that, now let's apply that same logic to Tuesday right here. Well, first part of the day, it clearly, it's always in the long. Probably, it's because it's the best stop entry of the day so far. But then you get this bar and you think, okay, well, maybe it's a low one short after a gap down, bottom of a trading range. But the stop entry, I still think the bull stop entry is better, but we may easily fall below bar one, so I'm just going to get out below this bar. And again, you think, okay, big tails, big tails. Is it always in short, always in long? I don't really know. I'm going to wait for about, to see what the next stop entry looks like. That's good. Well, then you get this bar. Well, you think, okay, maybe it's a double bottom. Maybe we're still always long here. I'll buy above, and then you get, maybe you hold. But once you get to here, you think to yourself, well, this stop entry, smaller risk, closed on its low. It looks better than the others, so I'm going to get out, maybe short below. So let's just, maybe short below. And you get down to here and you think, okay, second, I'll just get out because I think that, we're still always in short, or maybe you think it's always in long because the bottom of the range. Really all, my whole point behind this is, if you're a swing trader and you're not doing as well as you like, it's probably because you're getting chewed up too often. There are plenty of days, plenty of this. This is what will kill you. On a day like today, you will get killed if you're not careful. So all I'm proposing is simply be very careful when it's in a trading range. And if you're in the room, you heard Al talk about the Walmart trade that he calls it. On a day like today, you see this bar and you just short below, set a target 10 points lower. Don't even set a target. Just short and put your stop up, one tick above where it needs to be. Go to Walmart, come back to your computer in an hour, and if you do that, price is somewhere down here. But anyways, that's all another topic. So as far as today, I'll quickly just go over each bar. So bar one, it's a doji, arguably at the bottom of this range, but it's not that clear. Bar two, it's an okay stop entry buy, but again, big tail. Breakout bar three at 845, but bad follow through bar four, probably trading range. So if I was long, I'd definitely get out of short. I'd consider strongly going short below this bar. Maybe 2 legs down, probably not the low of the day. But hard to hold short, do you get out above this bar? Well, it's not easy, maybe rely on your stop. I don't know, there's not, I would not go long it here. I think it's okay to get out of a short, but I would not go long. And if you're trying to stay short, maybe you get short again here, but then again, you got to get out above this bar. Trading range, more trading range. We tested up, tested back to this close. You can see a lot of high close buyers got out back at this close. And by the way, just while I'm on the subject, you can see a lot of bulls who bought above this bar at 56.50, had bad follow through here. We're disappointed enough that they set a limit order to get out at break even at 56.50, and that's why price went to 56.75. It let them out and then went down. So anyways, back to today. Second entry short, top of trading range, double top. It's an okay swing short. Again, best signal bar is probably this, so we're probably more likely to swing down than up. And what's more likely? It's not 60-40. I can tell you right now, it's maybe 51, 52, 53% better for the bears. It's not great. Here, sign that the market may be changing, but just like this bar, what's the next bar going to be? Okay, sell the close, but you got to be careful. Probably second leg down. Here, follow through, clearly going down, always in short. More follow through, big tails, so it may start to pull back. The first question on my mind is, will scale-in bulls make money? Buy this low, you wait to buy more above the bull bar. Will they make money? So strong enough breakout, probably mine reversal. We might test up to here, but we may not. And you can see, then we got this. So second leg down, you can see you had bulls buy this close. During this bar, they bought this close, price tested down, and they got out. So you can see, the reason I say that is 60.75 is this close. Price went to 59.50, so it went 2 points lower. Price traded back to this close and let them out and take above. That happens a lot. And it's a little bit of a sign. Again, you heard this in Al's room earlier during the day. You heard him talking about it. Similar to over here. So you get a trend line break. You expect at least a second leg down, but probably double bottom. And look what happened during this sell-off. So if a bull bought this close, this bear close, if they bought it over here, price never let them out. You can see it just kept going down and it trapped them. So, you buy that close, you buy more, maybe here, and look what this is. So, or maybe you bought above this bar. What I'm showing you is the average entry price. It's tricky to, if you buy this close, here's one way Al will do this, and it's difficult to do. I would not recommend it. You buy this close during here, you buy 1 point lower, and then you realize you're trapped. Well, a lot of traders will double their position. So if they buy one contract and another contract lower, they'll buy 2 contracts above a bull bar, and they'll use an extremely wide stop. But you can see the issue with that is, tight channel, probably first up will fail. And if you bought above this bar, you can see how long you'd have to wait, and you'd still have to have a stop about 6 points below your second entry. So that's you need a very wide stop. But the whole point behind it is traders got trapped. And then today, we kind of had the same thing. Well, we did not have the same thing. It was different. You see, traders bought this close, scaled in, scalped out. So it's more a sign that we may be forming a trending trading range day. You can see the market's deciding, will we form a bottom and close this gap? Probably, when the market forms a trending trading range day, 60% chance that happens. So trading range, bear breakout, here's the gap. We went sideways and we closed it. Find a better example, one that's bigger. Yeah, here's one. So trading range, bear breakout, sideways. We closed all the gaps from the sell-off. That happens often enough, but you got to think about the swing trader. So always in short, clearly second leg down likely. Maybe always in bears get out above here, but they know that it's a minor reversal, so they're going to look to sell again. Doesn't trigger. Maybe we're forming a wedge bottom, and then at this point, do always in bears get out above? Maybe they do, but it's a minor reversal. I would not buy above. And then here, wedge bottom. I think always in short bears get out. Aggressive bulls will buy, but as I just said, it's a wedge bottom. Expect 2 legs up and expect a pullback. It's a mistake. It's a mistake to constantly look for wedge bottoms, in a strong bear trend, because you'll find them all over the place. Let's just find. I want to find a day where we just for 1 second. I can find it. Yeah, here's okay. Use this day. So, here's the open of this day. Strong breakout, and you can say, hey, wedge top. So 3 pushes first, 2, 3. I'll short below. If you're not quick to get out, you get stopped out. 3 pushes up, 1, 2, 3, 1, 2, 3. I'm gonna short below. And if you're not quick to get out, you're gonna get stopped out. 3 pushes up, 1, 2, 3. I'm gonna short below. If you're quick to get out, you get stopped out. And even if you manage to get out quickly, the one thing you'll notice is the fact that you're going to miss this whole move up, and you're going to maybe, if you're lucky, make a few points if that counter trend trading. So you have to be careful about that on a trend day. So anyways, again, minor reversal, aggressive bulls will buy, always in bears get out. But then bear market moving average, I think bulls get out, bears get short again, 50% pullback, stop up here. It's a 50% pullback from this. But again, you may get some sort of double top. However, I do think that if we do get a double top and a measured move down, it'll be the final flag. We also have measured move targets below. And by the way, one thing I wanted to mention, I think it was, I'll have to find it real quick. Yeah, okay, this is it. So, see this measured move right here? From the opening trading range, from this high to this low, projects down to 59.50. A lot of times on a 5-minute chart, especially in the Emini, price will come within 2 ticks. It'll test 2 ticks to a target. So this measured move target's 59.5. This price came down to 60 even. A lot of times, price will have to test down. We'll have to at least get within a tick of an important measured move in order to satisfy traders. So what does that mean? That means a lot of times price will turn up 2 ticks from measured move. And if you're aware of that, it can be another sign that we'll get a second leg down. So strong bear breakout, probably a second leg down. And then you see this measured move and you look at the slide and you say, gee, price came within 2 ticks. Usually when price comes within 2 ticks, it's got to test at least 1 tick or touch the measured move target. Now, if it doesn't come within 4 or 5 ticks, then it's different. It may not touch it. It's like when you get, it's like with anything. It's like when you test the open of the day, let's say we had a trading range bear breakout, we stalled out, and then we try to test the open of the day. You know how days when you get a bull breakout, it fails, and then you get a bear breakout. Well, actually, this may have happened right here. 575. Well, not really, not quite. But just when you see measured move targets, just be aware of that. I don't want to get off on that. But anyways, sideways enough in here. A double top, a lot of times double tops lead to the final flag. So this is a reasonable buy. Traders will buy this bar, they'll buy below it, and they'll buy more, probably down here, and they'll probably make money. So again, swing bears get short again if they don't short below here. At least always in bulls get out. It's still always in short. So some always in traders will buy and get long above here to reverse to long, but again, they've got to get out because it's always in short. They may sell this close, they may short below, they may wait for these 3 bars. But regardless, and breakout, probably at least another leg down. You may get a small spike and 2 more pushes down, spike the channel, similar to here, spike, 2 pushes down. But you have to also be aware. We just had a bear breakout of a wedge, 50-50 chance we get a measured move down. You can see there's a lot of targets holding down here, so we may have to test down here. Also, some traders, it's aggressive. Some traders will simply put a short on a stop 1 tick below here, and they get this bear breakout, and they're short. They just got filled. If this bar would have looked right here, so if we would have gotten a bull bar instead of follow through, closing on its high, they would have exited. Some traders would have gone long, but it's tricky because of the strength of this breakout. So regardless, always in short, probably sellers above, but stop up here. You can see there's our second leg. So right now we're forming a very interesting bottom, and it's like I just simply call it a high forward variant. And what that is we have three pushes of low, high one, high two, high three. So it's a wedge bottom. Then we triggered the wedge bottom, we broke below it, and so it'll be interesting to see, will we get three pushes and then a bear breakout and then another leg down forming a high forward variant, or, and this is the high forward variant, or will we get two wedge bottoms? So you get a wedge, first push, second push, third, bear breakout, and then first push, second push, third. If we do that, it's a reasonable swing buy. Now, why is it a reasonable swing buy? That's because the traders who bought around here. Because they bought above here, and they'll wait to buy lower. It's reasonable to buy up here. So, again, strong breakout, bad signal bar, probably sellers above, but it's a very tricky buy because we have a gap, we have an opening gap. We clearly closed this gap. So we're probably going to close this gap before today's over with. Not a great signal bar, so I would, let's put it this way. If a bull buys above here, they've got to get out on the low two short. I think it's okay for always in bears to get out above here. I wouldn't go long. But if they do, they've got a low two short closing when it's low. They've got a short again. And this happens a lot. It's kind of interesting, actually. It's basically a wedge. So you have a low one, low two, low three. However, this low two actually did not trigger before it went up and then down. It didn't trigger, go up and then go down, which sometimes happens. So you can see this had a lot of traders bought this closed, and maybe this was their effort to get out, or there's a lot of reasons. I think a big reason, more likely, is you have a low one short, traders buy this low scan, lower scalp out. So low one at 57.50. Bears bought 1 point lower, scalped out. And then here, you're getting a wedge bottom again, three pushes, but not a great signal bar. And again, we can easily get three pushes and then get another wedge bottom, break below the wedge, and turn up. So if you buy above, I wouldn't get out on this low. That's kind of tricky. I think I'd put a stop somewhere down here, or I'd just wait. I'd wait for a bull breakout or a better stop entry. And this may, a spike, first push, second push, third push, so who knows. Then we get a bear breakout, and it's a bear breakout of a channel bottom. And you probably heard, I'll say it before, a lot of reversals happen after you get a failed breakout of an extreme, such as in a bear channel. You get a failed breakout of the bottom. In a bull channel, you get a failed breakout of the top, something like this. And also, big bear breakout, closing when it's low. But again, is this a measuring gap or exhaustion gap? We know there's logical targets up here. We have a wedge bottom, bear breakout, three pushes down. So we're probably going to test the top of the channel, or something like that. If not, we're probably going to at least get up here, is what I'm saying. So bad follow through. I think always in bears get out, and always in bulls they really start buying here. They buy above this bar, buy here. Maybe put your stop a point below this bar. But at this point, it's clearly always in long buy for any reason. Still always in long. And, mission accomplished. We got back above here. And then look what happened. We're testing back into this lows. We closed this gap. And we finally, at the end of the day, got back above this high at 59.50. And you can see price went to 59.75, so it let those traders out. So, really not a whole lot on the day. if you're a perfect trader, hard to do. Maybe you just, if you were really lucky, you sold below here, stop up here, and then you got out here. You'd have made an incredible amount of money. But that's a very difficult thing to do. So, that's really my main. And by the way, when I say, so traders will buy, let's say they buy above this bar, okay? And then maybe, so if they can trade 4 contracts, this is something I'll talk about a lot. Traders buy one above here, and maybe they buy a second on this close, or maybe they buy a second at this low. Well, the next thing they do, first off, they use a very wide stop somewhere below measurement of target. So that's a tricky, maybe they just buy and they just use a 10-point stop. So they buy at 59.50, they use the stop at 49.50, all the way down here. So they buy above, they buy one below, and then they wait for a logical bull bar to buy more. And that's kind of more of a defensive strategy because, obviously you buy above and then you buy below, and if you catch the low of the day, you just take the profits. But if you buy above and you buy below, use an extremely wide stop. So you buy one above, you buy this low, and then maybe you buy 2 more at this low if you're lucky, or maybe one of these lows. And you can see average entry prices will be somewhere in here, and you can get out with a profit. All right, I'm going to go ahead and look at questions. My voice is getting a little hoarse. Okay, so give me one second. I'm going to get some water. I don't know how I don't know how Al does this for so long. Excuse me. All right, so for questions, have you tried trading other time frames like 2000 tick chart or 1 minute chart? Thanks. Yeah, I'll first start with that question. Yeah, to answer your question, I tried the 2000 tick chart route. I tried, 2000 tick chart, 6500. I know I think 6500 was Mac's popular. I've studied Mac, or Pat's price action. I think his first name's Mac. I think, I know that's a very popular person to study as well. I like Mac. You know, I think he is a legitimate person. If you listen to all of his stuff, it really does make sense. I mean, it's basically, to my understanding, two-legged pullbacks, buying high twos at the moving average in a bull trend, selling low twos in a bear trend. But again, I don't know a ton about Mac, so I know he does obviously more than just that. Personally, I've tried the 6500, tried the 2000, like I said, but my biggest issue always was I'm like Al. I really enjoy concrete, for instance, I love knowing that I like time charts. I like 60-minute charts, 15-minute charts. I like them because I know when the bar is going to close. For example, uh, this bar right here. So I was wanting to buy. I like a time chart because I know I can look at my clock and I can say, okay, there's 4 seconds left, 3 seconds left, 2 seconds left, and I know exactly when that bar is going to close. And I know you can you can make indicators or things that'll count for volume charts. When it'll let you know when it's going to get filled or how much volume's left. But to me that complicates a bunch of things because you know okay, if I really just trade the Emini, and but I'll still, I'm getting into forex, uh, but my primary focus is the Emini. So how do you do that with forex, or how do you do that with crude oil? Do you know how much volume should you use on a crude oil chart? I like everything being the same because if I use a 5 minute chart or any time chart, 240-minute chart, I can have all the same charts, right here. I'll just give you an example. So right here, these buttons up here, here's a 1 minute chart, 2 minute chart, or excuse me, 3 minute chart, 4 minute chart, 5 minute chart, 15, 30, 60 minutes, 140, 240, daily, weekly, monthly. And I can flip to anything. I can, here's the euro dollar, Japanese yen, all sorts of stuff. Excuse me one second. All right, sorry about that. Yeah, so, yeah, I don't want to get on a tangent. And my whole point is uh, just keep it simple. All right, here's crude oil. How do you know what a bond, I like time charts to make it simple because I can say, okay, I'll just look at a 15-minute chart or a 60-minute chart. Price action is the exact same. So, I don't want to get too far off with your question. But yeah, I've tried it, and it's personality. I just realized that the more I studied, first off, I'd recommend sticking to one chart. Just pick a chart. If you're going to study the 2000, I think the 2000 is a little too fast, in my opinion, especially the 1 minute. Here's a 1 minute chart, and let's find the open of the day. Can you really honestly tell me that you can trade this fast enough? Maybe you can, but I mean, just look how many reversals. Okay, did you buy above? I don't know. Do you short below? Did you buy? I mean, this is just, you gotta understand, all the way to here, that's, there's just so many bars. I know you have to remember, it looks, well, here's all I'm gonna say. Look at your performance, and if you're happy trading a 1 minute chart, 2000 chart, keep doing it. If you're not making money or making what not doing how you would like, try a higher time frame. That's all I'd say. I think there's nothing wrong with volume, but I think a lot of people see this on a 5 minute chart, so they try to go to the smaller time frame because it looks bigger. But you're not a computer. You have to remember that. There's a reason why this range is small. So, it's personal preference. It's as simple as that. I like 5 minute charts just because it's all the same. All right, so next question, I had a limit buy at the bottom of the trading range near 1030. How would bulls manage this when price action took them lower? Okay, so yeah, and that kind of goes into what I was talking about with over here. So yeah, that's the issue with limit orders and limit order trading. So at 1030, he wanted to buy the, well, let me, okay, so let's just assume, for simplistic sake, let's say he was going to buy the low today. You just set a limit order there. Well, my first question is, when you put that limit order in, what is your goal? And what I mean by that is, are you going for a swing, betting the price goes all the way back up to here, or are you going for a scalp? Because number one, what's your goal? If you're going for a swing up to here, it's low probability. Before you see any of these bars, that's low probability. So you need some sort of lower risk. Sure, and that goes into, okay, maybe you buy one tick above the low of the day, put your stop down here. You put your stop 1, 2 ticks below, and you hope for measure move up. Sure, that's okay, but I know that's not what you were trying to do. And second, the math is really low, and it's kind of like what I said over here. You could buy every stop entry. You buy above, short below, you go long again up here, you go short again up here, you go long again up here, then you're short again up here. And you're going to lose a little bit each time, you know. If you do it perfect, you'll basically break even and you'll make a lot down here. But low probability in general, hard to do. So anyways, going back to I know what you were trying to do. Everybody does it. And everybody gets hurt at some point. So, you know, the simple goal is, okay, if you tried to buy this low and you probably bought more, bought more, bought more, until all of a sudden you realize how big your risk was, and then at some point you have to get out. Well, you know, so ask yourself first, what's the difference between all of these bars and then these bars? The market cycle has changed. You know, you got to think. Okay, as I said earlier, take this 845 bar and take this bar. Well, what's the difference? Well, full breakout, bad follow through, still making lower highs, so still in a bear channel. Bear breakout, tight trading range, so probably going to get a swing up or down. You know, arguably always in short from this stop entry. You know, we have a double top, so we may get a measure move down. So we have a bear breakout. Now we have follow through. So you got to ask yourself at this point, we're probably going to get a second leg down at a minimum, if not more. You know, in general, this is one reason why I really like always in trading, is to trade always in correctly, you really have to, you know, if you're long and all of a sudden it's always in short, you got to get out. You know, to answer your question, really, to keep it simple, it's always in short. Clearly always in short at this point. So I don't care. If you bought this low, you have to get out here. And if I'm willing to guess, you knew in the back of your mind that you needed to get out if I'm really willing to bet. And I personally, I think it's at your, I think it's hard. People get too emotionally attached when there's too much risk involved. And if I had to bet, you're trading a position size that's too big, forcing you didn't want to get out here because you didn't want to take the loss. Until you get to the point where you just have to get out because you're so under the hole. And that may not be the case. You know, maybe you're trading really small. But to keep it simple, you can't be cute about it when you're wrong. That's something Al said. I'll never forget it. I asked him a long time ago about that guy. It sort of like a day like this. You know, I basically said it wasn't this day. This was, you know, sometime last year. And I remember we had a move down, and I remember I sold something like this high. I sold this high, and I sold another position here. Sold another position here, and all of a sudden the price is up here. And I remember you know, I had my stop up here, but then all of a sudden I was like, I don't want to get stopped out here. It might just be a trading range. It might test back down. You know, I was very much in the hole. I didn't want to accept what I was going to lose, so I said, okay, I'm just going to get out. And you know, I ended up getting out somewhere up here. Again, this was sometime, probably about a year ago, sometime last August, I think, or September, last September. And whenever he said it, he said, when you know you're wrong and the premise has changed, you just have to exit. You know, he has a rule. Al said he has a rule where if he buys this low, and it's clear, you know, he was wrong, he makes a mistake, clearly always in short, he'll just exit and market, you know. And that's one thing I recommend is work on exiting with market orders and not, you know, if you use TradeStation, don't go to a matrix and just put, you know, or set a limit order to get out. Just exit the market, you know, close your position. So I hope that makes sense. You know, truth is, if you honestly ask yourself, you knew you were wrong, and you just have to exit. It's just that simple. So I hope that helps. All right, I believe that's Just double check. So yeah, and in terms of how would bulls manage it, well, sure. There's really this goes into that skunk trade, and you see this measured move that I've drawn from this low to above here. Well, this is how they manage it. So you really have two choices. If you buy this low, you immediately get out, and then you look to sell, which I think is the far better route, or you buy this low, and you use a stop that is just insane. I mean, I don't know. How big? I don't know. Maybe 20 points. So, you know, here's an idea. Maybe you risk, I don't know, you buy one contract, you risk 20 points. Or, you risk somewhere down in here. I mean, that's risking 15ish, that's like risking 15 points. So, buy this low, put your stop way, way down here, and you just wait for a bull bar to buy. Well, so what's the issue with that? I think you're already realizing the issue. Number one is, what if you accidentally bought this bar? Well, you never got out. And, so if you never got out here, now your risk is pretty big. And so I just want to say something real quick. And then I'm going to have to end this webinar, but I'm just curious. So let's say you buy this low at 64 even. So 64. So that's 2164. Oops. Okay, 2164. And then you buy one contract here, then you buy two contracts here at 2159.5. Your average entry is 21. Whoops. Sorry, I just kind of messed up. Just bear with me 1 second. Kind of proving out, kind of a point here. Plus, then you add on two contracts here. I guess what I thought. So, yeah, okay, that's what I thought. So, anyways, just did some basic math here. So let's say, really, this is the only way I'd recommend doing this. So if you don't get out on this close, you buy here, you risk a very wide stop, 10 points, 15 points, and you wait for a bull bar, and you buy two contracts above a bull bar, such as right here. Well, if you do the math, do 2164 plus 2159.5 plus 21.59.5 divided by 3, it gives you exactly 2161. So you weren't alone with that. My guess is you probably did something in the middle. Traders who did the right thing, they got out here and they bought more, but they got out here or they held and bought more up and got out. So but that's really, really difficult. And even Al recommends, if Al's going to do that, he'd recommend buying one here, buying another 1 or 2 points lower, and then buying two contracts above this bar. That's risking that's basically asking yourself to risk 4 contracts at, 15 points. And that's $3,000 at 15 points. So that's hard to do. But that again goes into the middle, a skunk in the road, bound to get killed. It's the same thing, buying this low. So you buy this low, you buy more above the bull bar, and clearly you made money. Sorry, that's all the time I really have, and that's all for questions. So hope this helps. Hope everyone has a great night.